My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain you, but to educate you and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. If there's one word that defines this earnings season so far, it's NABAF. NABAF? Oh, come on, that's my totally made-up acronym for not as bad as feared. While this session seemed sedate on the surface, Dow gaining 24 points, S&P advancing 0.28%, NASDAQ rising 0.40%, underneath there were some bewildering moves that remind us the market doesn't always behave the way we'd expect it to. In particular, a bunch of stocks rallied today, even though they reported what looked like simply awful numbers. If you're befuddled, you've come to the right place. So how does the stock end up going higher in the wake of a seemingly ugly quarter? It's all about my buddy, pal, friend, NABAF. Let me show you how it works. We're going to start with the railroads, okay? The railroads are the best example.
All aboard!
This morning, Union Pacific reported what, even by its own admission, was a disappointing quarter. Their sales were weaker across every single cargo line. Energy down 20%. That premium, that includes the fabulous intermodal business, down 9%. Ag off 1%. Industrial down 1%. The cause of this weakness? Well, some cargoes have been troubled for a long time, like coal. But most of them are just plain economic weakness, slower autos, weaker lumber, and perhaps most importantly, and troubling, the absence of agricultural exports to, what do I have to tell you, China. The market's immediate reaction? Horror. I saw the stock down 4 points in pre-market trading. I said, oh, man, we're going to have a rough day today. Union Pacific is one of my absolute favorite companies. But I know that when you get such an ugly release, there is going to be some fallout, some selling, some obliteration. Sell. And there was fallout, at least until the conference call started. Then the stock starts to rally before ultimately going positive. It went up more than $2 before retreating, finished it up 37 cents. Still, think about it from down to up. Because even though so many volumes were weak, Union Pacific, it still made a ton of money. It's a testament to the fact that this is a changed enterprise. Thanks to tremendous expense control, maximized use of locomotives, precision railroading, knowing where all the trains are, getting in time, layoffs. They were able to generate some monster profits in spite of the weak sales. In the old days, it would have just been a hideous earnings shortfall. Union Pacific's just so much better run now. Plus, pricing held up just fine. That's a function, by the way, how competitive the railroads have become versus trucking, as well as some long-term contracts set during better times. As Lance Fritz, one of the best CEOs in the business, explained on the call, quote, we have been a little disappointed in the top line versus what we were hoping to see when we came into the year. As a result, we have adjusted headcount more aggressively to match that drop in volume, end quote. Hey, well, I remember when he was here talking about trying to find workers. There was no workers. Well, now he's over here saying, listen, we're going to let some workers go. So even though Union Pacific's operating revenue was down 7%, guess what? Their operating income only declined by 2%. It's almost alchemy. I mean, that's how you get a not as bad feared quarter. I mean, that's how a railroad stock can rally off of a revenue shortfall. It's about NABAF. We saw something similar last time from CSX, although their cargoes weren't as weak as Union Pacific's. But they did the same thing, controlling costs as part of their precision railroading techniques, which gave us another not as bad as feared quarter. Boy, they made a ton of money. What else? All right, last night, as I was leaving the office, step by step, inch by inch, I saw the not-so-hot report from United Rentals. Largest equipment rental company in America. And the stock, how about that Philadelphia accident? That's something. And then the stock collapsed after hours trading. Down 1, down 2, down 3, down 4. I mean, it couldn't find a bottom. But then on the conference call, we heard how United Rentals was able to rationalize costs to handle the downturn. A downturn they expected, a downturn they anticipated. Again, this is a classic sink-or-swim cyclical business that seemed to implode during times of weakness in the old days. Yet on the call, we heard how the company presciently cut spending, avoided being hit by the slowdown in oil and gas, once a key market for them. United Rentals ended up bottoming down 5% last night, and then it came roaring back. This thing finished up 5% today. Because the quarter was NABAF. Or how about Cramer fave Honeywell? This is one of the most consistent operators around. So I was momentarily concerned, if not frustrated, when I saw that Honeywell's revenue came in a little bit shy of Wall Street's expectations. And another time, that might have really hurt their profitability, causing the stock to get crushed. But now, it hardly seemed to matter. Company earned $2.08 more when the analysts were looking for $2.01. That mattered. Plus, they boosted their earnings forecast, even though they also took down the high end of the revenue forecast. Taking down the high end of the revenue forecast used to crush the stock. Plenty of investors were worried that Honeywell might see some sort of fallout from the Boeing 737 MAX woes because they do have a huge aerospace business. Nope! Instead, the aerospace business had 11% organic sales growth. No wonder the stock ended up rallying more than 2% today. And by the way, it's not done. You know what? The same thing happened to UnitedHealth, too, UNH. So many traders were terrified about the managed care company's earnings that its stock had gotten hammered to $220 going into the quarter. After rallying $18 the day it reported, UNH tacked on another $6 today. Again, it's not done. These numbers were much better than feared. So good that they allowed buyers to stop worrying for a few minutes about Elizabeth Warren and just enjoy how well the company's doing. Then there's Johnson Johnson, which was supposed to be hurt by litigation risk. Instead, the company proclaimed it was ready for any and all verdicts, which, by the way, have recently been going into their own direction. Not that anybody's talking about it. Hints of an opioid settlement gave them another boost. Now, the stock's finally broken out after languishing ever since the stories about asbestos and their baby powder broke. You've seen some headlines about plaintiffs winning huge damages lately, right? But you know what? They rarely hold up over a lot of scrutiny when they go to appellate courts. That and some fabulous blockbuster drugs and solid device numbers explain how J&J could have a NABF. The banks, NABF all over the place. How many times do we have to hear that the inverted yield curve is death sentence for the earnings? Those macro clowns, I mean, the macro people who specialize in that, I mean, can they shut up? Bunch of sunshine. Mount Banks. Trust me. All right, how many times did the sirens of skepticism tell us to avoid being even touching JP Morgan, getting near JP Morgan, staying in the same room as JP Morgan while the Fed was cutting rates? I mean, truly, these knaves don't know jack. Didn't matter. Thanks to a robust consumer and fabulous expense control, we've seen NABF numbers from every one of these. Literally. I mean, Goldman Sachs, boy, that had been such a... Do you catch that interview with Wilf? I mean, guys throwing a couple of ties. You're backers and journalists. Okay, so you're in California, allowed to walk around naked. Anyway, I'll have more to say on Netflix later in the show. But the stock rallied today, even though the company suffered from churn, slower subscription growth in the United States, and a huge increase in spending on original content. So why wasn't the stock crushed? Because Netflix earned $1.47 per share, and analysts were only expecting for $1.03. This has never really been an earnings story, though. It's still a big, breathtaking beat. That's why the stock initially rallied as much as $22, close to only up 7. And once again, we got a not as bad as feared result. Of course, not every disappointment is a NABF disappointment. Some are genuinely bad, dark clouds with no meaningful silver lining. Look at IBM. If you can, hold it just a second. I want to look at it. Where are those? Merger. Oh, they're the merger bot. Look at IBM. I mean, it reported slightly better earnings, but weaker than expected sales. You can only look at it with these. These are special glasses that protect you from the actual numbers that IBM reported. Even though they recently bought Red Hat, a brilliant deal, it wasn't big enough to move the needle and offset the decline in IBM's enormous legacy business. It's obvious what's happening here. The doom and gloom brigade controls the narrative, but the CEOs of most companies that have reported so far saw the pain coming and took decisive action to cushion the blow. They deployed new technology, made tough decisions, and they turned lemons into lemonade in almost every case, except for IBM. The bottom line, all these not as bad as feared quarters are good news for shareholders who haven't been shaken out by all the darn naysayers. More importantly, the reminder that execution matters. Perhaps with this industrial and enterprise slowdown, it matters more than ever. Get used to the name, NABF. And watch the guys on the day side pronounce it Naboth. Stephen in California. Stephen!
Professor, this is Stephen Michael calling from San Diego, California.
San Diego, I spoke to Adrian Gonzalez today.
Yes, sir.
He's a smart fella. What's up?
I had a question on GW Pharma manufacturers.
Sure enough.
They're the only ones that have the medication Epidiol, which can stop seizures in babies and children.
Right.
They received approval to distribute their product a month ago in the European Union, which gives them a brand new huge market.
Okay.
But their stock has dropped from 100.
Well, that's because there's been this ongoing raid on the company that the stuff doesn't work. I've not been able to determine that it doesn't. To me, it does. And more importantly, it's part of the vast cannabis abyss. That doesn't seem, today it bounced for a little cannabis. I got to tell you, I think GW Pharma is a good company with a good product, but the bears will not let go. I'm going to Mike in Florida, please, Mike.
Hey, Jim.
Mike.
I see the broader market doing really well, going up, but there's a pocket of stocks. There's some growth stocks / software companies.
Okay.
And they're actually going the opposite direction.
Right, the software as a service companies, the highly valued ones.
I'm going to call out one of them. Your CEO, the CEO was on about 3 weeks ago, and just wanted to get your thoughts on Zscaler, down about 50%.
Oh, my. I mean, Zscaler, this is one of Heather Gaines's favorite companies. She's integral when it comes to Zscaler and also to CrowdStrike. And by the way, Zscaler and CrowdStrike are in a civil war to be able to get customers, and that's why it's been bad. I have to tell you, though, I think that I've been watching Palo Alto Network, and that stock is going up, even though my charitable trust sold it, and it's really killing me. All right, now there is a prevalent thesis in town. It's called not as bad as feared, and it controlled today's it's really today's action. And that's good news for shareholders who didn't get distracted by the naysayers. Naboth! All right, well, Mad Money tonight. What's going to happen to the stock market if my old pal Larry Kudlow ends up being right? I'm giving you my take. Then, is it time to tune into Netflix? Really? I'll tell you if the company could be streaming profits in the future. And it's a biotech up more than 190% just year to date. And maybe you should put it in your radar. Cramerica, could it be worth adding Arrowhead Pharmaceuticals to your portfolio? I'm going to talk with the CEO. Stay with Naboth and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.